At the heart of financing decisions lies the Modigliani-Miller theorem in its simplified form, which suggests that, in a perfect capital market, no taxes, transaction costs, or information asymmetry, a firm's value is independent of its capital structure. However, real-world imperfections make this a crucial decision. Debt financing, leveraging, and risk. Concept of leverage. Debt financing introduces financial leverage, which magnifies both returns and risks. When a firm's return on invested capital exceeds the cost of debt, interest rate, the return to equity holders is amplified. Example: if a company borrows at 5% and earns a 10% return on its assets, the excess 5% accrues to the equity holders. Tax shield. Interest payments are tax deductible, creating a tax shield that reduces the effective cost of debt. This is a significant advantage of debt financing. Example: if a company pays $100,000 in interest and has a 30% tax rate, it saves $30,000 in taxes. Financial risk. Debt creates a fixed obligation. Failure to meet interest and principal payments can lead to financial distress and bankruptcy. Intuitive approach. Think of it like a mortgage. If you miss payments, you risk losing your house. Similarly, a company missing debt payments risks losing its assets. Agency costs of debt. Conflicts can arise between shareholders and debt holders. Shareholders might engage in risky projects to maximize their returns, even if it endangers the debt holder's investment. Example: a company close to bankruptcy might sell off safe assets to pay dividends, leaving debt holders with only risky assets. Bonds versus loans. Bonds are tradable debt securities, allowing for broader market participation. Loans are typically negotiated with banks, offering more flexibility in terms and conditions. Equity financing. Ownership and growth. Ownership dilution. Issuing new shares dilutes the ownership stake of existing shareholders. Intuitive approach. Imagine a pie being divided among more people. Each person gets a smaller slice. Cost of equity. The cost of equity is the return required by equity investors, which is generally higher than the cost of debt due to the higher risk. Capital Asset Pricing Model (CAPM). A common method used to calculate the cost of equity. Retained earnings. Reinvesting profits avoids the transaction costs associated with issuing new shares. However, it forgoes the opportunity to distribute those profits as dividends. Opportunity cost. The opportunity cost of retained earnings is the return that shareholders could have earned if the profits were distributed as dividends and reinvested elsewhere. Agency cost of equity. Conflicts can arise between managers and shareholders. Managers might pursue their own interests rather than maximizing shareholder value. Example: a manager might overinvest in projects that enhance their prestige, but do not generate sufficient returns. Market signaling. Issuing new equity can be perceived as a negative signal by the market, suggesting that management believes the company's stock is overvalued. Intuitive approach. If a company truly believed its stock was undervalued, it would likely buy back shares rather than issue new ones. Optimal capital structure. Firms strive to find an optimal capital structure that balances the benefits of debt, tax shield, with the costs of debt, financial risk. Trade-off theory. This theory suggests that firms balance the tax advantages of debt with the costs of financial distress. Pecking order theory. This theory suggests that firms prefer internal financing, retained earnings, followed by debt, and then equity as a last resort. Market timing. Management may time equity issues when the stock price is high, and debt issues when interest rates are low. In an economics context, financing decisions impact a firm's weighted average cost of capital, WACC, which is a crucial determinant of its investment decisions.